Hi, I'm Jillian again with 5-Minute Finance from MoneyStream. Welcome to this week's topic. We'll be talking today about some of the definitions and terms around loans and interest rates and how you can also handle paying off consumer debt. First, I'm going to give you some definitions. Some people have asked about APY and APR and what those mean. So APY is annual percentage yield, and it's a term that applies to savings accounts. So it talks about the total yield you'll get in interest after your fees and charges on your savings account. It's a better indicator of how much you're going to get than just looking at interest rate because it subtracts out the fees and charges. So if you're looking at different savings accounts, you want to ask about the APY, not just the interest rate. Now we're going to look at APR. APR, or annual percentage rate, is similar to APY in that it's a total cost and it looks at fees and charges as well as the interest rate. But APR applies to loans you might take as opposed to APY, which looks at savings accounts. So APR is the rate you're going to pay on a loan that you get. And that includes both interest and any fees and charges. So again, if you're shopping around for a loan, you want to compare the APR on the different loans so that you get the total picture of how much you'll be paying. Of course, the more you borrow and the higher your interest rate is, the more you'll be paying on your loans. And the lower your monthly payment, the longer it will take you to pay off that loan, and the more you'll pay in interest along the way. You want to take into account the APR when you're looking at credit cards, especially if you expect to be carrying a balance on the credit card. If you are carrying a balance, then the APR is the amount that you'll be paying as you go along to carry that debt. So it's interest plus your fees and charges. If you are carrying a balance on your credit card, it's also important to pay off more than the minimum payment every month. Within MoneyStream, you'll notice there are different settings on your credit card accounts. You can choose to pay the full statement balance on your credit card every month, and of course that's a great idea if you can do it. There's also a setting to show the minimum due on your credit card every month if that's what you'll be paying. But I recommend choosing the setting that says it varies, and if you do that, what we'll do is we will estimate, MoneyStream will estimate the payment for the next month based on what you've been paying every month. And if you try to pay a little bit more on your credit card than the minimum due every month, you'll pay it off faster and you'll pay less interest. So for example, perhaps you're carrying $1,000 in debt on your credit card and the minimum due is only $50. But you're going to try to pay $200 every month. Set your settings on that bill to it varies, and MoneyStream will plan for you to pay $200 every month. Of course, it's still up to you what you want to actually pay each month, but at least you're taking that plan for $200 into account in your planning and your cash flow within MoneyStream. Okay, that's it for this week's 5-Minute Finance. If you have other questions, as always, please let us know on our Facebook page, send us a tweet on Twitter, or right here in the comments below. Let us know what your questions are. We'd love to answer your questions.